All right, I just wanted to do a quick recording and talk about M1Finance and kind of review a portfolio I started this year. In the past, I've shared a bigger portfolio of mine that I received a little bit of criticism from, saying it's not realistic for somebody that is starting out investing to start with the amount of money in a portfolio that I shared. True enough, I wasn't necessarily sharing that portfolio as something a beginner should do, and I'm not doing that now. I was just sharing a portfolio to show how I build a portfolio, and also how I to basically prove that I actually do invest money, right? I think there's a lot of people on YouTube that talk about investing and don't actually do much investing. So with that criticism, back at the end of May of this year, I decided to experiment with M1Finance. I've never used M1Finance. I've always stuck with more traditional brokerage websites. So this was something new to me. I kind of fidgeted around setting things up on my phone, so I have some kind of weird names, and I wasn't sure what to name things and what it actually meant when I was setting that up. But I did start with a small amount of money, as you can see here. Back in May, I started with, it looks like $750 or so. So I think that's a very reasonable amount that anybody that's serious about starting to invest can come up with $800 to start their investments. And then as you can see here, I basically add roughly about $100 a week to the portfolio. So let's just say $400 a month roughly. Some months a little bit more, some months a little bit less, but on average probably around $400 a month. So again, if you are serious about starting to invest, $400 a month should not be outside of your wheelhouse. If you have a job and if you're serious about investing, you're not buying Starbucks coffees every day, doing some sacrificing to come up with the money as a new investor. So as we can see here, over the last year, or basically the whole time period that I've held this M1Finance account, I've got a 10.36% return. Not great considering the market, but not bad either. I'll take it. Total return of around $339. So again, not too bad. Let's take a look at some of my holdings here. So as I'm getting a little bit older, I realize I don't have a ton of bonds. Most of my money is either in my 401k in various ETFs or mutual funds, and again, not many bonds. So I'm trying to slowly increase the amount of bonds in my total overall portfolio. So as you can see, my number one holding is actually the Vanguard Total Corporate Bond ETF. Pays a good solid monthly dividend, and like I said, a monthly dividend, which is nice as well. So if you're younger, or you don't think you need bonds in your portfolio, you can totally disregard that. So this is one of the quirks. I don't know what I clicked on, but somehow I opened up like a subsection of a slice of my portfolio. So this wasn't something I intended to do. It was pretty much when I was first learning how to set this up, I must have clicked on something strange on my phone. So we'll skip over this for now, but we'll jump back in there and take a look at the stocks that are in that subsection. I just wanted to let you know there's really no significance to that subsection. All right, so Microsoft, Microsoft has had a great run. In my larger portfolio, I hold a decent amount of Microsoft. I think I'm up somewhere near 200% in that, so I've held it for a long time. It's been a great fund, I think, or a great stock. I think it's going to continue to be a great stock. Is it worth adding a lot of money in there right now? Maybe, maybe not. I mean, it definitely isn't as cheap as it was when I was first adding to my holdings in my other account. But I think they got a great thing going on in the cloud, and they're basically competing with the other three-headed monster there, Amazon and Google. And I really like what Microsoft's doing. I like what they have to offer. Goldman Sachs now. General across all of my holdings, I've been adding more and more to the financial sector. When interest rates earlier this year were going up, a lot of my financial holdings were doing really well. I've also worked at a variety of banks over the years, so I have a lot of holdings from employee stock purchase plans, essentially. So I have quite a bit of money invested in financials now. This is probably one of the reasons why my portfolio is only up 10% year to date for this M1 Finance portfolio, is because I have a decent amount of financial holdings, and the financial stocks took a beating a little bit when interest rates were going up, and then they suddenly came back down. But again, I'm not worried long term. I think these will be great holdings, and I'm going to continue to hold them. As you can see across this portfolio, all of these companies pay dividends, some more than others. Most of them are growing dividends at a pretty good clip. I don't necessarily reach just for a dividend payment, but I like stocks that pay a dividend that is growing the dividend, that do have a chance to have some capital appreciation. All right, WP Carry. This is, I think, one of the only ones that I've held for a decent amount of time in this portfolio that is down. I've been adding to my WPC holdings here. As it's come down, I've been buying a little bit more. As a side note, with M1 Finance, I like the platform. Originally, I started it to invest in the commission-free trades. Now pretty much almost everybody is offering that, so it's not as big of a benefit. But one thing I don't do with M1 Finance is I do not do the rebalance. As you can see here, I'm over kind of the set share targets for each one of these. I don't rebalance. If I do want to rebalance, I'll rebalance manually by buying and selling. Another thing I don't do is I usually don't do the auto invest where it just splits, whatever, say the $100 I'm contributing that week. I don't split that among all of the pie. I basically pick a holding or two that I want to invest in, and I take that $100 and split it however I see fit within a select holding. So basically, I'm kind of controlling what I'm investing in when, still working within the limitations of the trade window that M1 Finance enforces, but I'm not doing that, buying, say, 20 different shares of stock in very small increments. I think that's crazy, especially since this isn't a retirement account. It kind of creates a nightmare at tax time, and that's something I don't like. Same thing with the rebalancing. That can kind of create a nightmare as you're, buying and selling a lot of small amounts of shares. All right, let's keep going. So Home Depot, everybody that's been watching this channel for a while knows how much I like Home Depot. They recently had an earnings miss or an expectation adjustment, and they dropped down. I basically have Home Depot stock. I used to work at Home Depot when I was in college. I have a employee stock purchase plan from that. That's something I still own, and I'm adding to it. Basically buying the dips. Home Depot is a great company. It's not going anywhere, pays a solid dividend. I have whole videos on Home Depot, so I won't go into any more detail there. Target. Now, I really like Target. I think they're weathering the online retail apocalypse very well. They pay a great dividend, a growing dividend. My wife likes to shop there, which isn't it doesn't influence my buying decision, but I spend a lot of time at Target because my wife likes going there, and I'm comfortable. I see people loading up their shopping carts, spending a lot of money. I see the same people when we're there frequently doing our shopping also there. So there's a lot to like about Target in my opinion right now. Okay, JP Morgan, another financial stock. Up 15%, not too bad there. I really like JP Morgan Chase, great company. They do a lot of things well. Again, it pays a dividend. It's a decent growing dividend. Vanguard S&P 500. I had some money for a while that I wasn't. I wasn't really finding anything that jumped out at me that I absolutely loved. So I was just kind of throwing some money into the S&P 500. Kind of spreading it out. I'll probably move this out and move it into something else in the near future. But so that probably next update that will actually be gone. Berkshire Hathaway, again, big amount of holdings in financial stocks through via Berkshire Hathaway, insurance stocks, things like that. A lot of people think Warren Buffett has kind of lost his touch. Not happening, not yet anyways. I like Berkshire Hathaway. Probably one of the only stocks in here other than Google here that does not pay a dividend, but Berkshire Hathaway, basically, you can't miss it. Going into potential recession or correction territory, I think we have to eventually hit one of those. Berkshire Hathaway is a great stock that will take advantage of downturns in the market to either acquire whole companies or to basically add to their stock holdings, and I will continue adding to Berkshire Hathaway. It's basically like having a small mutual fund. No concerns there from me. Google. This is one, like I said, I buy a lot of dividend stocks, dividend growth stocks. So Google doesn't pay a dividend. Why am I holding them? I've worked on some projects with Google and their artificial intelligence, their machine learning, their optical character recognition. Some great technologies there that basically they can take applications, say a loan application for a car from your car dealer. Now, there's car dealers all over the U.S. that they submit loan applications all different ways. Some of them, small ones, do it through mail. Some do it through email. Some do it through fax still, believe it or not. So the banks that basically provide auto loans through the auto dealerships take these applications in all different kind of crazy ways. Now, this is a lot of manpower for banks to process these things. So using something like Google's optical character recognition software, they can take those applications, and this software can actually recognize handwriting on these applications, take that handwriting and put it back into the bank's back-end systems, so they can basically have less manpower, less chance for error, because this is it gets more and more accurate as it builds like a book of knowledge of what it's looking for. It's just an amazing tool combined with the cloud, of course, Google's major advertising platform and their ad platform through AdWords and Google AdSense. So I mean they offer a lot. They're known for search and their advertising, but they're doing a lot of other stuff in the cloud. And these softwares like the optical character recognition, that there's a lot to love about Google. All right, United Health Group. Now, United Health Group, I kind of have a love-hate relationship with it. They basically get smacked every time the healthcare sector, there's some kind of the Obamacare or the Obamacare rollback, or anytime there's anything to do with the health sector that is negative in the news, United Healthcare gets slammed. So anytime this happens, I buy some United Healthcare. Great company. There's nothing on the horizon, in my opinion, that's going to negatively affect them long term. And as you can see here, I'm up 28% in United Healthcare year to date. Great holding. I like it. Pays a small dividend. The company meets everything I look for in a stock, and I'll continue to add basically on the dip whenever there's any negative health news. Okay, Costco. I really like Costco. Up 14%. Solid holding, solid return so far. I'm going to continue adding to Costco. They pay a small dividend. I like their membership model. They basically, once they get you as a member, it's hard for people to not like Costco once they go in there. They renew their membership. They kind of got, they're known for, being a great retailer, and great retailers are what is going to survive in competing with online retail giants like Amazon. So Costco, they're looking to continue to develop their online presence. Same thing with Home Depot and Target. They're doing the same thing. These are three wholesale/retail retailers that are basically weathering the storm. They're going to compete with Amazon, and I think in a way, some aspects are better than Amazon because they have a decent online presence now. They have a loyal customer base, and you can do in-store or you can do online with them. So again, it's kind of the marquee retail stock in my opinion. Moody's, not doing overly well in this holding. They pay a solid dividend. They have decent dividend growth. They are very they if you look at the history of Moody's through when there is corrections or recessions, they weather this storm really good. They're a company that they fill a very niche market, and there's not a lot of other options, so they kind of have the business cornered. I think this is something that Warren Buffett would look into and kind of like the overall business, the moat that they have, and he generally buys stocks that pay dividends. It pays a solid dividend as well. Intel, again, with United Health Group, this is probably one of my better returns throughout the year. This was simply a negative news play. I can't remember what it was. It was earlier in the year. I think Intel actually missed their earnings or had a negative year-over-year outlook. And I like Intel. They pay a good dividend. They're not going anywhere. They them and AMD have pretty market share on the semiconductor market. So I added to Intel. I will continue to add to Intel. I like Intel. I have it in some of my other accounts. Up 29%. I'll take it. Southwest Airlines. I actually had for my MBA class. I just recently finished up my MBA within the last year. Southwest Airlines was a company that we actually had to do a case study on. As part of your MBA degree, you basically have to do a lot of research on existing companies. One company was Costco as well, and I also had to do Southwest Airlines, so I dug into these companies a lot. I'll basically on the dips, I'll add to Southwest Airlines. They pay a dividend. They're a great airline. I think they're, one of the better run airlines out there. They definitely have a loyal customer base, which a lot of airlines don't. Customers absolutely hate them. So again, Southwest Airlines I'll add to on the dips. U.S. Bancorp, another financial stock. This is more of a very large regional bank within the United States. Pays a solid dividend, has good dividend growth. I think has good prospects as the banking industry changes from a more branch-based model to a more online model. They're kind of at the sweet spot where they can continue to invest in, adding to their online presence while divesting branches that are not profitable and don't make sense in today's environment. So I think there's a lot of cost saves by them divesting in these non-performing or underperforming branches while also being able to, invest in their IT infrastructure and basically convert their loyal customer base to be more and more online, giving them what the customer base wants. All right, Lockheed Martin. So this is a stock that I very rarely dipped into the defense sector. Pays a really good dividend. Has decent dividend growth. I think we're kind of locked into these long-term wars all throughout the globe or skirmishes throughout the globe. I think there's a lot of investment in technology and kind of staying a step ahead of the enemy from a technology and staying ahead of other countries even that we're not necessarily seeing eye to eye with in our ideologies. So all of that's to say basically we're going to continue investing in defense spending. I think there's it's a sector I want to look more and more into. It's not something I have deep intimate knowledge of, but I'm comfortable with LMT here. And like I said, I'm going to continue looking into other defense stocks, so I'll keep you guys updated as I do. All right, Union Pacific Railroad. I had Canadian National Railroad, I think it's called. I think the symbol is CNI. I had that for a while. I don't like buying foreign companies. I like what they were doing. They paid a good dividend. They were a little bit smaller railroad, but they had basically one of the only rail lines from Canada southward into the U.S., which is kind of a moat in its own right. I just didn't like how the taxation of that, and it was kind of quirky around tax times. I do like Union Pacific. I think the railroads are a good place to be, as right now fuel prices are down, which means generally railroads have to be basically running a tight ship to basically keep expenses in line. And when fuel prices go back up, which they will go back up eventually, more and more organizations will use the railroads to transport stuff because it'll be the most cost-effective way to do that. And Burlington Northern through Berkshire Hathaway is now privately owned, so I own a little bit of railroad through that. And also Union Pacific now pays a good dividend growth. All right, the Vanguard REIT ETF fund. I don't hold a lot of ETF funds in here. I don't think it's needed, but basically REIT stocks, as the interest rate environment it started climbing back up, REIT stocks were getting hurt. I started dipping my toes in all my different accounts into more and more REIT stocks. And basically, as the rates come back down, which has hurt some of my financial stocks, it has helped the REIT stocks, right? Because REIT stocks depend on getting money at a reasonable interest rate, which when interest rates are down, a lot of times they can get a very advantageous interest rate to allow them to make a lot of money. When interest rates go back up, these stocks might be hurt, but as you probably know, REITs pay a solid dividend. Generally across the board, this fund pays a solid dividend, and it also gives me some exposure to real estate, which I don't have any personal real estate investments other than my primary residence. I don't have any rental properties, so I like dipping into a little bit of individual REIT stocks, a REIT ETF fund, and then I also have a little bit of alternative REIT-like real estate investments through things like Fundrise, which I may do a video on in the future. But again, just trying to get some different exposure other than individual stocks here with some real estate. Cisco recently, they had some negative reports in the news. Again, a great company, pays a solid dividend, not going anywhere. They've faced some headwinds in the past and always have come out better. So again, dipping my toes in the water here, will continue to add to Cisco long term. Unilever. This and Cisco were relatively new additions to the portfolio. Not much to say here. Solid dividend payer. I will continue to slowly over time add to the stock. I'm not overly excited about it, but it gets me out of the technology type stocks a little bit, out of the retail and REIT and financial stocks that, as you can see here, a lot of my holdings are in financials, REITs, and technology type stocks. So just something a little bit different, not overly crazy about it, but going to continue to research it. And again, just kind of dipping in a little bit here. All right, so this other section, this dividend growth section, again, it was something I created. I don't know how I created it. I think I clicked on something wrong in the M1 app when I was newly setting this up. So I've just thrown some other stocks in here. But like I said, there's no significance to having this broken out this way. So let's just take a look at what's in here. Okay, as you can see, this section of my portfolio hasn't been doing as well. It is some stocks that I'm not as crazy about overall, but let's go through them. So Casey's General Stores, they have a variety of convenience type stores. Up 9% year to date. Not too bad. Overall, I'm happy with it. They pay a small dividend, and they're growing their dividend relatively fast. So it's a high growth dividend stock that I think long term will do well. We'll see, but I'm going to keep adding to this on the dips as well. Cedar Fair, this is more of a kind of a Peter Lynch type purchase where, he says buy things you're familiar with. So the family and I go to Cedar Point in Ohio pretty much. I think this year we went maybe 4 times. We drove from New York to Ohio. We really enjoy Cedar Point. I haven't. They're a REIT that owns. If you're not familiar, it's a REIT that owns theme parks throughout the United States. I think Cedar Point is their biggest theme park, but there was some rumors over the summer where Six Flags was going to try to acquire Cedar Fair or merge with Cedar Fair. Never went through. The stock popped right after that, and I actually had some small amount of shares of it then, and it has since come back down. But they pay something like I think it's like a 6 or 7% dividend. Let's see here, dividend almost 7%, 6.5%. So they pay a relatively high dividend. And this is more of just something a place I like going. Their theme parks are immaculately clean, usually well run. And they did a promotion this year where they sold $97 end of season passes for 2019 that are good through 2020 season. So that's I forget the exact number, but they sold an ungodly amount of these passes at $97. When they basically have very cheap staffing too, at least at Cedar Point. I'm not sure if it's like this with all their parks, but they bring a lot of college age kids, almost like I don't want to say exchange students, but like college age kids from outside the U.S. There's kids there from like Ukraine and different Asian countries, Africa, all over the globe, working there, and they don't pay these kids along with their U.S. workers terribly well, but they have this pool of labor, and I think it's a great opportunity for them, right? Because they get to come to the U.S., work, interact with people they probably never would be able to get to the U.S. or at least Ohio, at any other time. So I think it's a great experience. It's a win-win experience. I think it helps out Cedar Fair, and again, their parks are pretty nice. WP Carey, so I held this in the other section of the portfolio. Again, this was kind of a quirk with me learning the application. I'm not going to go through that again, but I'll probably end up selling this one and just have it in that other section of the portfolio going forward. As if and when I sell any of these stocks, I'm just going to slowly kind of wind down this kind of confusing subsection of the portfolio. Toyota Motor Corporation, again, they pay a solid dividend. I like Toyota. They have vehicles that are known to be very reliable, very well-run company. Another company I studied as part of my MBA. I think there is some challenges as, we get into different kind of cars. I know Toyota's been investing in basically where a time where, cars you might not actually buy a car and use something more like an Uber type service. So they're kind of making preparations where, they already have hybrids. They're them along with all the other auto manufacturers looking more and more into electric cars. So the auto industry, there's a lot of kind of disruption and upheaval that is potentially going to occur, within the next, say, 5 to 10 years. So I think Toyota is well prepared to start looking into life after, where all of us might own an individual personal vehicle. And I think Toyota is going to be one of the automakers that figure things out. They're usually pretty good. All right, starting to lose my voice, so we're going to start wrapping this up here. But UPS, I think there was, as Amazon kind of gets more and more into their delivery service for Amazon stuff, I think UPS and FedEx is shaking a little bit. Is Amazon going to master the logistics of delivering their own stuff and then roll it out as a service to other companies? I mean, I could see that happening. I haven't heard anyone from Amazon talking about anything like that in the near future, but I could imagine once they get their their processes kind of ironed out, they have all these distribution warehouses they're setting up throughout the U.S. and other places in the world. At least in the U.S., they're really building out their delivery network. Semi trucks and the small warehouse to consumers or household delivery vans. They're building out that network. They're setting up actually independent contractors that worked in the warehouse to actually do that and start their own mini business, which is kind of cool. So I could see them basically taking a chunk out of UPS and FedEx in the long term. I think short term, I think UPS is best of breed, pay a good dividend, a little bit of dividend growth. Fuel prices are down, which helps, the delivery, UPS and FedEx. So at least in the near term to moderate term, I like UPS. Maybe long term, not so much. We'll kind of keep an eye on what Amazon's going to do in that sense. All right. Lastly, another retailer, Tractor Supply, pays a very small dividend, modest dividend growth. So Tractor Supply generally appeals to the hobby farmers. So individuals that say have 5-10 acres of land that, might have a horse or some chickens. They're not like the big kind of industrial type farmers or huge farms. They're more of like the people that just enjoy doing those things because they have some acreage and want to say that they have a couple chickens or something like that. They have a very loyal following from that customer base. They have a little bit of like hardware store type stuff. I'm not sure if you've ever been at Tractor Supply, but they have a good mix of farm type equipment, clothing for people that like to do farming type stuff, as well as some basic kind of like hardware store type supplies. And they're usually in places where like a Home Depot or Lowe's isn't. And they're usually in kind of those communities that are kind of right on the edge of rural and more residential, like as residential starts thinning out. So they're kind of in a very niche market in that respect where they're located. So it's kind of I like that they're the only basically hardware store / farm supply store that are kind of in those general areas other than mom and pop stores. So they're not competing directly with Home Depot or Lowe's. They found their own little slice of that home improvement market along with the farm related items. So combined with a loyal customer base, it kind of fits the retail profile I like, that has either a very niche market that they kind of corner, or they have a very good, physical retail presence and online presence like Target, Home Depot, and some of the other retailers like that have. Tractor Supply really doesn't have that great online retail presence, but they have that kind of niche market that's not affected by Home Depot you're not going to buy horse supplies like a stall mat, right? It's basically recycled rubber tires that weighs like 40-50 pounds or more, and they're kind of big, bulky, awkward. I don't know if you ever moved one, but I have them in my home gym, and it's not something you're going to buy off Amazon. So they a lot of their products from the farm side are things that you would never really buy on Amazon. So, they have their loyal customer base and their niche retail locations with things that are too awkward to purchase online that don't make sense. So I think they're in a good spot to grow over the long term. And I think they will continue to do that. And again, it's not a stock I'm overly crazy about, but it's a stock I like. And as there are general market pullbacks and Tractor Supply pullback as part of that, or if there's any, earnings misses or anything like that, I'll continue to add to my position. All right, guys, I am really losing my voice here. I don't generally talk this much in my videos. I hope you like the portfolio review. I'll try to do one of these monthly. We can see how it goes, see how much I add to the portfolio. If you have any questions, post below. If there's stocks you don't like that I invest in, post your reasoning below in the comments. I would love to hear what you disagree with me on. I don't expect you to agree with everything I say. And if there are any stocks that I invest in that you do like, let me know in the comments. Excited to hear what you like about these stocks as well. All right, guys, take care.